Charlotte McLeod with the Investing News Network, and here today with me is Rick Rule of Sprott Inc. Thanks so much for joining me today.
Always a pleasure, Charlotte. Thank you.
Of course. And today we're here at PDAC. It's day 2, and I think the topic we need to start on is these gold mega mergers they have talks going on around them. There's news coming out even today. Broadly, what are your thoughts?
Well, I think the mergers are a wonderful thing for the mining business and the mining investment business. In the first instance, when a takeover occurs at a premium, the shareholders of the acquired company get liquidity and they get hope, two great ingredients in the market. Intelligent mergers, though, also benefit the acquirer. Larger companies, more liquid companies enjoy higher share prices and a lower cost of capital. Obviously, in a capital-intensive business, a lower cost of capital is a wonderful thing. Thirdly, one of the things that the mining industry really suffers from is too much general and administrative expense. There's too many management teams, too much management compensation. In a merger, you have the ability to shed redundant managers. In the case as an example of the Barrick-Newmont merger, the suggestion is that the savings from combined overhead could exceed $1 million a day. Put in perspective, $300 million, $350 million a year, that's a really good mine, except for a mine with no sustaining capital investments and a mine that doesn't deplete. Very, very, very important. Of more importance, I think, to your listeners, is the fact that the mergers that we're seeing today will benefit the junior and mid-tier miners extensively. And here's why. First of all, the hope in the market makes the markets more buoyant, but more particularly, the major mining companies, when they merge, sell off assets that are redundant to companies their size, which could be the stuff of life to a junior. Access to properties and access to the intellectual capital of the majors. You may recall, or you may not, because perhaps it was before your time in the sector, but the last merger mania we had in the sector at the end of the decade of the 90s really set up some of the explosive growth that occurred in the junior sector 3 or 4 years later. And in this circumstance, I believe past is prologue. As much as $14 billion worth of properties will come onto the market as a consequence of mergers in the next 18 months, and many, many, many talented people. And this will be real lifeblood to the juniors. So I am, as you can tell, very excited about this circumstance.
Yes, I was going to ask you if there are any similar historical periods where we've seen this happen, and how do we let that inform us of what comes next?
Let me give you a dramatic example. In the late 90s, we were at a low in the copper cycle, and copper companies were merging, and copper companies were selling off assets that were redundant to them. My good friend Ross Beatty, mercifully with Sprott backing, formed a company called Lumina Copper, where, if my memory serves me correctly, he bought 7 projects that had no value to the majors that he thought he could improve on. He paid probably $30 million all told for those 7 projects. As his cost of capital fell, he invested probably $80 million additional dollars in those projects. So he had $110 million in, and he sold that company for $2 billion. It's that sort of explosive accretion of value that occurs from better utilizing people and better utilizing properties that I think will be the hallmark of the next 5 years, much as they were the hallmark of the beginning of the last decade.
So if you're an investor right now and you're trying to plan your strategy during this environment, should you be looking for those companies that may be buying those assets? Should you be looking for companies that may be taken over? Something else?
I love questions like that.
Okay.
The answer is yes.
Yes.
Yes, you should look to companies that are going to be acquired, particularly if you're a trader. The real money will be made backing the teams that buy the assets that get shed by the majors. There are probably 20 teams worldwide now, a couple of them in your hometown in Vancouver, that have the capital resources, the human capital, and the capital markets know-how to utilize what will really be a smorgasbord of properties and people to grow. That's where the real money will be made. But it'll be tough, and it'll take 3 or 4 years.
Okay, so does this tell us anything about where the gold space is right now, where the gold price is, and where that may move going forward?
This tells us more about where the gold price has been.
Okay.
People don't merge because they want to, they merge because they have to. And the last 7 years have been extremely hard on the gold business after some good years. It also tells you that this has to happen because general and administrative expense in the gold industry, the mining industry as a whole, is way too high. These mergers have to take place because we need lower general and administrative expense relative to assets under management or relative to EBIT. This is happening not really because the managers want it to happen, but because it has to happen.
These mergers, acquisitions, takeovers, not all of them are good. What are the hallmarks of a good takeover deal?
The hallmarks of a good takeover deals are one that are strategic. They don't take place merely for growth's sake, but they take place because there's operating synergies between the assets, because somebody's assets are strategic to somebody else. In theory, I'm not saying it's going to occur, but in theory, the Newmont-Barrick merger generates tremendous operating synergies, as an example in Northeast Nevada, where the company's holdings basically interfinger. The mergers that don't work are mergers that take place late in a bull market, where people do mergers because they can, not because they have to, and where they pay too much.
Okay, so staying on gold, I think you said yesterday, speaking here, you're feeling good about gold this year. Do you have any specific price movement that you expect to see?
Charlotte, I'm far too old to answer that question.
I have to ask.
I understand completely. I can tell you in a very general sense that my experience has been the most important determinant of the gold price is a representation of a global faith or lack of faith in the ongoing purchasing power of the US dollar. Very rarely in my career, this is the third time, gold and the US dollar have been strong simultaneously. On the prior two occasions, the dollar has rolled over and gold has done extremely well. One can hope, of course, that past is prologue.
Okay, other than gold, what sectors are you looking at this year? Where are you putting your money?
Well, those are two different questions.
You can answer them separately.
In terms of sectors, as you know, I'm attracted in the intermediate term to the uranium business. I love it precisely because everybody else hates it. I love it because the price of uranium is unsustainably low. I love it because it's deeply out of favor. And I love it because the last time the uranium market ran, it ran so extravagantly that I can afford to wait for that blessed event to occur again. But in terms of what I'm doing with my own money, that's a different circumstance. I am playing the mergers and acquisition game two ways. I'm trying to find companies that have assets that are strategic to somebody else who will buy them. Buying the companies that I suspect will be taken over. That's a game that I'm playing with this year's money for this year. I am also actively looking at who the management teams are that we will be able to back, as I described earlier, to buy redundant assets and hire redundant people and go into a sort of a hyper-growth phase for the next 5 years. That worked for me spectacularly well in the 2000 to 2005 period. I remember it with, as you can tell, real fondness. The second thing that I'm doing is I'm buying companies in the royalty and streaming space. Many people believe that those companies are overpriced relative to the rest of the industry, but I disagree with that. Their operating margins are 4 times as high, and you pay up for quality. People also believe that those companies, that their best growth period is behind them, and I disagree with that too. I think that the streaming companies will finance mine construction for non-investment grade mining companies. They'll finance mergers and acquisitions, and increasingly they'll be used to finance base metals project developments worldwide. So I'm buying the royalties and the streamers. Finally, I think we're back into the beginnings of an exploration cycle, one that we haven't seen since the middle of the decade of the 1990s. So I'm also allocating capital to generative exploration, particularly among the prospect generating communities, people who use their intellectual capital and other people's physical capital to explore prospective terrain around the world.
Okay, so uranium and even the royalty and streaming space, those are places where there are not too many companies.
Correct.
Do you prefer looking at those kind of small pools, or is it better to have a larger pool to choose from?
That depends on the investor. For myself, I'm doing both. I've been, lucky enough in my life to accumulate a fair bit of capital, and I believe that we're coming into a new resource bull market, so I'd like to get a lot of that capital allocated. Some of that capital is going to go into Franco and Wheaton Precious. the two best companies in the space. I want beta with no risk. Some of me wants to be in smaller companies where I believe that I understand the recipe for growth better than people who compete with me as an investor. So I'm in fact doing both.
Okay, and exploration, are we seeing enough of that right now?
No.
No.
We have both underinvested and misinvested, and we've done it for 20 years. We are living as a society, I don't mean this industry, I mean you and I, the way we live on deposits that were discovered 40 years ago, put in production 20 years ago. These deposits are, like your guest, getting past their sell-by date, long of tooth. And we need to, as a society and as an industry, replace those projects, but we haven't looked for them with sufficient diligence for 20 years.
Well, and I don't think anybody outside the mining industry for the most part are thinking about, okay, that's something that needs to happen.
I think that's correct. I think people take all matter of commodities for granted. Many people, sort of believe that vegetables come from the supermarket. They don't understand that something had to happen to get them there. And the same thing with metals. When people talk about basic commodities, they don't equate them with things like refrigerators and automobiles and cell phones. It's a truism that everything in the world that's tangible was grown or mined, but people's imaginations are in a different place now.
Okay, we can leave exploration after one more question. Do you think there are major deposits out there still to find?
Without question. Almost every deposit that has ever been discovered has been discovered because somebody stumbled over it. It outcropped. Most of the world's surface is covered. So most of the deposits that haven't been discovered are undercover. You can't stumble over them. We are developing better and better and better tools to find projects, to find mines that are undercover. And the next 20 years, provided that we continue to employ that technology and we continue to invest, we will discover these things. A great example is unfolding right now, Ivanhoe Mines, with the Kamoa-Kakula deposit. One of the greatest copper belts in the world is the Katanga Copper Belt in southern Congo. In the western extent of that, it's under sand, undercover. Robert Friedland and his team figured out that the copper didn't particularly care, that sand was on top of it, and explored the western extension of that belt undercover and found what may be the most important copper discovery in the world in 100 years. That's a classic example of what remains to be found.
Okay, well that's good to hear. As we wrap up, are there any trends that you would highlight for investors that they may be missing for 2019?
Yeah, I think the most important trend for investors is their own education, mastering their emotions, understanding that this is a cyclical business. Bull markets, which people love, are risky. Bear markets are sales when goods are on sale. And if investors will teach themselves that the price of a stock is less important than information concerning its value, they will begin to do well. The second thing I'd like to say with regard to trends, I know it's not where the question goes, but it's where the answer is that asking yourself questions where the answer begins with when, not if. Circumstances like uranium, where it's bound to happen but you don't know when. Asking questions where the answer begins with when involves answering yourself a much higher quality question than one where the answer begins with if.
Okay, well that's great. I think we'll leave it here for today. Thank you so much for joining us.
Pleasure. Thank you for having me on.
Thanks. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Rick Rule of Sprott, Inc.